It's evening here, and about 4 hours ago, I watched something break on my screen that made me pause my entire day. While everyone's talking about Maduro getting captured in Venezuela, the silver market just had what I'm calling a phantom event, a violent, silent decoupling that most people won't even notice until it's too late. I'm a private commodities analyst. I've been stacking physical silver and tracking these markets for 12 years. And I built this channel because I got tired of waiting half a day for mainstream news to report what I could already see happening in real time on my Bloomberg terminal. There are a lot of AI avatar channels popping up lately, pumping out silver hype with fake news. This isn't that. This is what I'm actually seeing in the data right now and what I'm personally doing about it. Here's what the big brokerage desks are telling you. This is the bursting of the 2025 bubble. They're saying that the 150% gains we saw last year were a fluke, and that today's $3 drop is the beginning of the end. They want you to believe that silver is collapsing under its own weight. But the screen is lying to you. This isn't a collapse of value. This is a mechanical event called a passive flush, and it's being weaponized by the exact same people who are telling you to sell. Someone is trying to buy your silver at 2024 prices, and they're using a billion-dollar math trick to make it happen. So before you touch that sell button, I need to show you something. I need to show you the numbers they're hoping you never calculate. Here's my claim, and I'm going to prove it with actual math in a few minutes. Large institutional brokers are exploiting a predictable $600 million mechanical index rebalance to manufacture a $6 billion panic sell-off. That's not a typo. $600 million in real selling pressure is being leveraged into $6 billion in perceived panic. And the motive is simple. By front-running the Bloomberg Commodity Index weight adjustment, dealers are hunting your stop losses to satisfy their own maxed-out risk limits. What I'm going to do in this breakdown is walk you through the passive flush mechanism step by step, run the actual math that proves the media is exaggerating the selling pressure by roughly 10 times, and then I'll share my personal battle plan for the $74.25 support level. Because once you see the numbers, you'll understand why I'm not panicking. Let me show you what I was looking at a few hours ago. Silver was sitting at $75.84, down 3.71%. That's a brutal move. But here's the thing that caught my attention. Gold was nearly flat at $4,447, down only 0.35%. Stop for a second and think about that. Usually, silver and gold move together. They're in a dance. When one drops, the other follows. But today, silver is being dragged into an alley while gold is just standing there, barely moving. I pulled up the charts, and what I saw was a massive red candle starting from the morning open. It's what traders call a shaven head candle, a violent, clean drop with almost no recovery. The DXY, the dollar index, was up slightly at 98.91, but not enough to justify a 4% dump in silver. Gold should be bleeding too if this were a real macro move, but it's not. We saw a violent rejection at $83 earlier this week. Now the price is desperately trying to find a floor at the $75 psychological level. And here's where it gets interesting. While the paper price on the COMEX is screaming panic, the physical reality hasn't changed. Industrial demand from China and Japan, the EV sector, solar panel manufacturing, all of that is still there. None of that disappeared overnight. The charts look like a death spiral, but the engine driving this move isn't human. It's algorithmic, and that's what I want to explain to you now. Let's pull this apart. I need you to understand something called index rebalancing, because this is the core mechanism behind what we're seeing today. Here's the simple definition. Once a year, major commodity indexes have to reset their portfolios to match their preset allocation rules. It's mandatory, it's scheduled, and it involves the movement of billions of dollars. This isn't some conspiracy theory. This is publicly disclosed information that happens every single year like clockwork. Here's why it matters for silver. Because silver was a top performer in 2025, it now takes up too much room in the Bloomberg Commodity Index, which everyone calls BCOM. To stay within their own rules, the funds that track this index are forced to sell silver to bring its weight down from 4.49% to 3.94%. Think of it like this. Imagine a grocery store that's forced by corporate policy to sell off all its high-end steak just because the steak took up too much dollar value on the shelf, even if there's a line of hungry customers out the door waiting to buy it. The steak isn't bad. The demand didn't disappear, but the policy says it has to go, so it goes. Now here's the trap. This is where it gets ugly. Professional dealers know the exact dates of this rebalance. For BCOM, it happens between January 8th and January 14th. Today is January 8th. They know this is coming. So what do? They front-run the move. They start selling early to drive the price down. And when the price drops, it triggers stop-loss orders from retail investors who have their positions set to automatically sell if the price falls below a certain level. This creates what we call a cascading sell. Retail panics and dumps their positions, which drives the price down even further, and then the dealers who started this whole thing can buy back in at the bottom. The steak is on sale, but the store is trying to convince you it's rotten. Now let me show you the math, because this is where the narrative completely falls apart. The Bloomberg Commodity Index has total assets under management of $108.8 billion. The weight adjustment we're talking about is a drop from 4.49% to 3.94%. That's a shift of 0.55%. Let me do this calculation for you. 0.55% of $108.8 billion equals $598.4 million. Let's call it $600 million to keep it clean. That's the mechanical selling pressure. $600 million. That's real. That's happening. That's the rebalance. But here's what I am seeing circulated on social media and through broker cold calls. Rumors claiming the selling pressure is $6.8 billion. That number is being thrown around as if it's verified, as if it's the real number. Some of these brokers are calling their clients and telling them there's roughly 15% of the entire COMEX open interest being dumped. Do you see the gap here? There's a $6.2 billion discrepancy between the mechanical reality and the fear narrative. $600 million is real. $6.8 billion is a lie designed to make you panic. We know the rebalance is happening. We know the weight is dropping from 4.49 to 3.94. We know the dates. And we know that gold is holding firm at 4,400. If this were a real macro collapse, if this were a true bubble bursting, gold would be sliding with silver. Liquidity would be getting pulled from the entire precious metal sector. But that's not what's happening. This is a targeted strike on silver's liquidity. This is a layer of synthetic shorts being piled on top of a small mechanical adjustment to create the illusion of a massive sell-off. So if the math doesn't support a crash, why are brokers reportedly calling their clients to pitch aggressive short positions? That's the question you should be asking. Now, I know some of you are thinking, this sounds like conspiracy talk. So let me steelman the skeptic argument, because it's important to be honest about this. The skeptic says, this isn't a conspiracy, this is mean reversion. Silver gained 150% last year. A 10% flush is just healthy profit taking. And the rebalance is simply the catalyst that triggered it. Markets go up, markets go down. This is normal. Here's my rebuttal. If this were a healthy mean reversion, if this were a macro bubble popping, we would see gold and platinum sliding in lockstep. When liquidity gets pulled from a sector, it doesn't discriminate. It pulls from everything. But gold is holding the $4,400 floor. Platinum isn't crashing. This is surgical. This is a targeted raid on silver's liquidity. And let me bust one more myth while I am at it. The claim that silver is losing its safe haven status. I keep seeing this narrative pop up. Here are the facts. Industrial hedging for solar and EV production for 2026 is at record highs. These are real companies with real supply chain needs, and they're the ones waiting to buy this dip. They don't care about the paper price drama. They need physical metal, and they know a sale when they see one. The smart money is using this dip to lock in their 2026 hedge positions, while they tell you to run for the hills. Think about that for a second. So what happens next? Let me walk you through what I'm watching for over the next few days. First, institutional reaction. If this volatility continues, watch for the CME to potentially hike margins. Margin hikes are the hammer they use to force the last of the leverage longs out of their positions. If you're trading on margin and you get hit with a margin increase, you either post more cash or you get liquidated. It's a brutal but effective way to clear out weak hands. Second, media blackout. I expect the mainstream narrative to completely ignore the BCOM rebalance and instead blame fading industrial demand. They'll point to some random data point and say demand is weakening, despite the fact that the China-Japan trade tensions are actually threatening supply, not demand. The story they tell won't match the data, but that won't stop them from telling it. Third, and this is critical, stop and look at the gold-silver ratio. It's spiking vertically right now while gold stays flat. This is the hallmark of a technical raid. When you see the ratio move like this independently of gold's price, you're not looking at a fundamental shift. You're looking at a targeted attack on silver's paper market. The dashboard I'm watching has two scenarios. Either we get a V-shaped recovery or we see a slow bleed into the 60s. There's not much middle ground here. The next 72 hours will determine if this is a dip to be bought or a regime change in how silver trades. And that brings me to my personal battle plan because I want to be very clear about what I'm doing with my own positions. I'm laser focused on the $74.25 support line. If we close below this on a daily time frame, the technical damage likely extends down to $68. That's a big move, and I need to be prepared for it. I'm not hoping it doesn't happen. I'm planning for what I do if it does happen. Indicator check. I'm watching the DXY, the dollar index. If the dollar breaks above 100, the tailwind for metals disappears. A strong dollar is kryptonite for precious metals. And if we see that break, I'm sitting on my hands until the currency volatility settles. I'm not trying to catch a falling knife in a strong dollar environment. Here's trigger A. If silver dips into the $72 to $74 range and I see the RSI showing an oversold divergence, meaning the price is making new lows but the momentum indicator is showing strength, I'm personally looking to add to my long-term physical position. Not paper, physical. I'm talking about taking delivery, adding to the stack, because I believe the physical market is disconnected from this paper nonsense. Trigger B. If we see a V-shaped recovery back above $78.50 before the Friday close, I will personally treat today's action as a successful stop run. And I'm maintaining my current exposure without any changes. That would tell me the raid worked, they shook out the weak hands, and now we're back to normal programming. Trigger C. If the gold-silver ratio continues to spike while gold remains stable, I'm interpreting this as a silver-only event, and I will not be spooked into selling my gold. Gold is behaving rationally. Silver is being manipulated. I'm not going to let silver's drama infect my gold positions. I have my levels. The question is, do you? Let me also be clear about what I'm not doing. I'm not panic selling. I'm not calling my broker to open short positions. I'm not listening to the cold calls telling me to get out now before it's too late. I've seen this movie before. I've watched these mechanical rebalances get weaponized into fear campaigns, and every single time, the people who panicked were the ones who regretted it 6 months later. If you're holding physical silver, if you're stacking for the long term, today should not change your thesis unless your thesis was based purely on momentum. If you believe in the industrial demand story, if you believe in the supply constraints coming from geopolitical tensions, if you believe that central banks are going to keep printing money and debasing fiat currency, then a $3 drop because of an index rebalance should be noise to you. But if you're leveraged, if you're trading on margin, if you're in short-term options, then you need to have a plan. You need to know your stops. You need to know your risk tolerance. Because this kind of volatility can wipe out leverage positions in a matter of hours, and I have seen too many good traders get blown out because they didn't respect the power of a coordinated raid. I want to take a step back for a second and talk about why I'm even making this video. When I started building this channel, it was because I was frustrated. I would see something happen in real time on my terminal, and then I'd have to wait 12 hours for CNBC or Bloomberg TV to maybe mention it in passing. By the time the mainstream news covered it, the move was already over. The opportunity was gone. And now, with all these AI avatar channels popping up, pumping out silver hype videos with no real data, no real analysis, just clickbait and fear-mongering, I felt like someone needed to step up and actually explain what's happening with real numbers and real sources. I'm not here to tell you to buy or sell. I'm not a financial advisor. I don't know your situation, your risk tolerance, your time horizon. What I can do is show you the data I'm looking at, walk you through the mechanics of what's happening, and tell you what I'm personally doing with my own money. If that's valuable to you, great. If you think I'm wrong, that's fine too. But at least you'll have the information to make your own decision instead of just taking some broker's word for it when they call you up and tell you the sky is falling. Because here's the thing. The broker's calling you right now, the ones telling you to short silver, the ones saying this is the beginning of a crash, those same brokers are the ones who benefit when you panic. They make money on the spread. They make money on the commissions. They make money when you trade out of fear instead of conviction. I don't make money when you trade. I make money when I'm right about my own positions. So my incentive is to be honest with you about what I'm seeing, even if it's uncomfortable or goes against the mainstream narrative. And right now, what I'm seeing is a $600 million mechanical event being used as cover for a $6 billion psychological operation. The numbers don't lie, but the narrative does. Let me recap this for you, because I know I've thrown a lot of information at you, and I want to make sure the key points are clear. We are witnessing a $600 million mechanical rebalance being used as a smokescreen for a $6 billion broker raid. Silver is decoupled from gold, which tells us this is not a macro move. The physical demand from industrial users remains strong, and that's the coiled spring that everyone is ignoring while they focus on the paper price drama. Don't let a passive flush wash away your conviction. The numbers don't lie, even when the brokers do. If you want to understand the deeper story behind why I'm not worried about long-term silver demand, go watch my previous video on the China-Japan trade spat. That's the hidden floor for silver prices that nobody is talking about. That's the fundamental reason why I believe this dip is temporary noise, not a structural breakdown. I'm going to be watching this closely over the next 72 hours. I'll update you if anything significant changes, if we break through key levels, or if new information comes to light that changes my analysis. But for now, I'm sticking to my plan. I know my levels, I know my triggers, and I'm not going to let a predictable index rebalance turn into a panic-driven mistake. The market is a transfer of wealth from the impatient to the patient. Today is a test of which one you are. I'll see you in the next one.